So our next guest really blew me away with his financial knowledge and just how to really take control of your money and what to do with it so that you can be debt free. Let's check it out.
Building spirituality, family, health, and business. This is The Giant Builders with Lois Wyant.
Welcome, Giant Builders. I'm so happy that you decided to join us. I'm very honored. I do ask that you like and leave comments on our social media. The links are below. So today's guest is Howard Palansky. Hello, Howard. How are you?
I'm doing great, Lois. How are you?
I'm doing wonderful. The sun is shining, the birds are singing, my flowers are blooming. What more could be? So, can you tell our guests a little bit about who you are?
Yeah, so um, Dr. Howard Palansky, now live in Austin, Texas for a really long time, enough that when I first got here, there was only one tall building. So if anyone visits, they're like, I don't think that was possible. And the answer is yes, it was. Um, but prior to coming to Austin, Texas, I was actually a dentist. So the Navy paid for dental school. I owed years back as a dentist. So I did 1 year in Chicago. I did 3 years in southern Japan. And then after, as I told the Navy I was getting out, they said, okay, where do you want us to move your stuff? Looked at a map and said, Austin sounds good. And that's how I ended up here. Um, and from there, I opened up my own dental practice here in the Austin area and had it for 9.5 years. And that's when life kind of took a pivot. So in 2016, I was just starting to get burnt out, but I didn't know what to do next. And now I tell people sometimes life leaves you little clues, and other times life hits you with a 2x4. So my 2x4 moment was Sunday morning, Memorial Day weekend, 2018. Jaden, my older son, is now 12 years old. I'm sitting next to his bed. He realizes I'm there and he says, Dad. His voice is barely above a whisper. Yeah, buddy. I lean over the bed. I put my ear over his mouth to make sure I can hear him. And he says 3 words I'll never forget. Am I dying? 12 days earlier, Jaden came home with a stomach ache. 3 days after the stomach ache, we're in the ICU at the Children's Hospital having emergency surgery. 29, it was appendicitis that turned septic. 29 days in the hospital, 19 of them in the ICU, 8 straight days of sedation because he went to the operating room 5 times. After they take the tube out of his throat, they give him methadone and morphine to bring him down from the drugs he was on. So imagine your child or grandchild looks like a heroin addict coming down from a high. And the very first question they will only ask you are those 3 little words. Am I dying? My first breath was, did I hear him correctly? My second breath was, do not lose it right now. I look him in the eyes. I tell him, no, you're not dying. You've had prayers from thousands of people all around the world, and you're going to be just fine. He looks at me. He knows I'm telling him the truth. He closes his eyes to get more rest. I walk outside the room, and then I broke. I was already miserable. I was burnt out from dentistry, and I was taking it out on everyone around me. But when I broke, only one thought seared into my mind. If life is this fragile and I'm unhappy with the path that I'm on, burn the ships. It's over. That's what I did. Sold my practice. September 2018, just walked away.
Wow. I think I'm gonna cry. Just to even see such a young little body go through all that, that's horrible, man.
Yeah, I mean, I'll fast forward because people are I don't want to leave them in suspense. Is your son okay now? The answer is yes. He is now 19 years old. He just finished his first year of college. No long-term health issues. Taller than me, better looking than me, has more hair than me. So, I mean, yeah, Lois, it was hell. I don't wish this on any family, any person that they have to go through what I did. But it was the stepping stone or the pivot to be able to go to the next thing. And as brutal as that was, sometimes you just need that kick in the rear end to say, do something different.
Yeah. So how did you decide what to do next?
The answer was dumb luck.
I like dumb luck.
So,
The dumber the
so
better.
yeah, I mean, look, sometimes it's just being in, it's not being the right place at the right time. It's being the right person in the right place at the right time. And so the circumstances, I mean, like, look, for over a year when I just quit dentistry, I was floundering. Right. But couple of things just kind of came together, which is why we're talking now. So as I'm transitioning out of dentistry, I'm sitting with another dentist who asked an obvious question. How are you walking away? And I'm going to guess for your audience that they're not healthcare providers, which is totally fine. But to understand the amount when he asked that question, the two most expensive dental schools today in 2025 are the University of Southern California and New York University. They are telling the incoming dental freshmen for the next 4 years, expect the debt just for those 4 years is going to be $800,000. Now, granted, those are the two most expensive dental schools, but let's just say dental school on average is about $400,000. That's not including college. That's not including your spouse's loans. That's not including buying a practice or starting a practice from scratch. I didn't even talk about living in a house anywhere yet. I didn't talk about cars. I didn't talk about actually living. All right. So for the average dentist who's in their 30s, they probably have $1.5 million of debt.
Wow.
I don't know what the exact number was for this dentist when he asked me, but I made a dumb comment to him, which changed everything. I kind of figured out how to make money move. Now, he gave me that Scooby Doo look. I tried to explain things that day. Frankly, I just didn't do a good job. But a few weeks later, I get the next statement in the mail for my house payment. I take a picture of it. I send it to him as a joke and said, hey, take a look at this. Lois, my house payment was $24.19.
What, did you live in a doghouse?
No, no, it's in the ebook you downloaded that you can see the picture. But well, all he wrote back is, I see it. I don't understand how you can have a $24 house payment. I'm buying a condo next month. Will you be my coach? Okay. He paid off the condo in 8 months instead of 30 years. And so he tells his business partner, I tell a friend of mine what happened. They become the next two people I help. And now all of a sudden, I'm listening to my heart instead of my head. And it says, the way you're going to make an impact in this world, it's not dentistry. It's not doing another root canal. It's not doing another crown. The way you're going to make an impact in this world is by teaching people these new rules of finance and the system around it so that they can get to their freedom sooner. And so that's why I'm honored to be talking to you and to your audience today to just explain how this works.
All right, tell me, where does one start?
So it all starts with the actual tool that allows this to happen. And the magic sauce is a line of credit. All right. So now the question is, what the heck is a line of credit? A line of credit's just an open-ended tool that allows money to flow through it versus the one-way street. The most common example of a line of credit is a credit card. You call a bank, you get approved for, let's just say, a $10,000 limit. You purchase $3,000 of goods and services. At the due date, if you don't pay the $3,000 off, you still have $7,000 available in the line. And I call that availability access to cash. But once you pay the $3,000 off, you have the full $10,000 available again. So money's flowing through this tool versus a mortgage, car payments, student loans. You make that payment, it's a one-way street. You make that payment against your house, it's now locked up in the titanium safe. You can't get it back out. And do you find any irony in that a mortgage and an amortization table have the same root word, M-O-R-T, as mortuary and mortician?
Well, that's quite a
Okay?
coincidence.
No, it is, but it's not, because
Yeah.
the word mortgage is actually two French words put together that literally means death pledge. So the system is set up for you to make payments until the day you die, or you're going to die trying. But now, if you have this open ended tool that you broke open the titanium safe, now you can utilize all of your income to manipulate the debt and hence manipulate the amount of interest you're going to pay. That's the system. That's the whole thing. There's the magic trick revealed.
So a credit card. Did I miss something there?
Well, a credit card is an example
Okay.
of a line of credit. I do know people that say you can do this whole system on credit cards. If we have to get to the point that you're using credit cards to do this, I would strongly encourage you that this is not the right thing to do. Okay. But there are other examples of lines of credit. So the way I got down to the $24 house payment is I don't have a traditional mortgage anymore. I don't have the one-way street. I completely busted open the titanium safe and I use a home equity line of credit as instead of a mortgage. So when I get paid, I put all my money in. And when I have expenses come up, I take the money out that I need to pay the expenses. So I'm using my house as a checking account. Okay. If you are a business owner, since we're talking in terms of the Giant Builder podcast, if you're a business owner, you should be able to get a business line of credit. The rule of thumb is 10% of your annual revenue. So if you're a $2 million revenue generating business, you should be able to get a $200,000 business line of credit. Other examples is if you are a believer in permanent life insurance, there's something there called cash value. You can get an insurance line of credit. If you have a stock portfolio, not retirement accounts. So we're not saying IRAs and 401ks, but an after-tax portfolio with Vanguard or E-Trade or Schwab or Fidelity, you can get they call it an asset-based line of credit. So you don't have to sell your Microsoft or Johnson and Johnson or Google stock. You can use that as collateral to be able to get cash off of it without having to deal with capital gains taxes. So this is the idea, is how do we use these assets that you only see in one direction and now have these as multi-directional tools to be able to have enough flexibility and freedom to do what you want, but also know how to pay things off faster.
All right, so take me back to your house. All right, so you opened a line of credit. You paid off your house with that line of credit?
Almost. So what ended up happening is I had my debt on the mortgage. Okay. So I for step one, I had a traditional mortgage.
Okay.
Step two, I refinanced from a traditional mortgage into a home equity line of credit. Okay. Now, with the higher interest rates, and people say it's like, but I got a 3% interest rate. So in that case, we can keep the mortgage that you have with the 3% interest rate. And behind it, or what's called second position, we can get a home equity line of credit. Okay. So either way, it does not matter. But in my case, I completely got rid of the one-way street. Now I have a two-way street as my debt tool for my house. I had a mortgage. I sold my practice. I didn't know what to do with the money, but I'm like, well, if I put it against my house, now I can get the money back out. And so I did. So I just smushed it all together. My balance on my house at the time went down to like $2,000. So I generated a whopping $4.19 in interest, and the bank said we have to charge you a minimum of a $20 payment. There was the $24.
Okay. All right. So, all right, walk me through the process. Like if I wanted to buy a car, what would your first suggestion would be?
And awesome question. So let's just say, forget about, we can say buying a car, you can currently have a car. So, so let's just say that you currently have a car. All right. You got it at, because your credit's good, you got a smoking deal to 0% interest rate. You have $12,000 remaining. The cost of the payment's $400 a month. So in 30 months, you're going to pay this off. And you also have a line of credit already set up in place. And the interest rate on that is 10%. And so what I would tell you is take money out of the line of credit and pay off the balance of the car. So you're just going to do a balance transfer. And usually the red flag goes up and say, but I have it at a 0% interest rate. Why
Yeah,
would I move
but I
this
was
into
gonna go
something
with.
that's,
Yeah.
yeah, why would I move this into something that's a 10% interest rate? Here's why. Number one, the line of credit, the only thing that you have to pay on is just the interest that accrues. Okay. So it's a simple interest tool versus the fixed debt payment. Because let's just say one month you put $700 against the car. What's your payment the next month, Lois?
It's the same.
It's the same $400 in our example. It does not change. That's the problem with an amortization schedule.
Mhm.
Okay. Number two is I am looking at your cash flow. I don't care about interest rates. I care this widget or this item in our example here, this car payment is taking $400 of your cash flow every month.
Mhm.
But if we move that into the line of credit and the only thing we're required to pay is just interest, our payment now goes down to $100 for that month. And so if it's a lean month for you, Dave, a lean month, which would be easier to pay, 100 or 400?
Obviously 100.
Right. But wait, it gets better because now that we have eliminated this $400 payment from our normal expenses, but we added $100 of interest, our net change in cash flow is positive $300. Okay. So
Right.
let's just say that. So if we kind of give the whole big example here, let's just say that the money that hits your checking account every single month was $7,000 a month after taxes, after retirement contributions, after medical insurance. Your expenses while you still had that car payment was $5,300 a month. And I know they're trying to scratch this down. That means that we have $1,700 a month in extra cash flow or extra profit in our personal financial company. Okay, our normal lifestyle. If we now net an extra $300, now our cash flow just went from 1,700 up to 2,000. Okay, so this is now our starting point. Income of 7,000, expenses of 5,000. We have this $12,000 debt inside the line of credit. And what we're going to do moving forward is to say, because we have this open-ended tool, we can put all of our money against the line of credit. Why? Or the debt inside the line of credit. Why? Because it is open-ended. If I put that money in today, I can get the money back out tomorrow.
Okay, I get you. Okay.
All right. And so what ends up happening is we start at 12,000. Let's just say we got paid on the first of the month, the entire 7,000. We ask ourselves a question. Where do we keep the money? We have three places. Keep it in the checking account, move it into a savings account, or now we can do option number three, move it into the line of credit. We move it into the line of credit. The balance goes from 12,000 down to $5,000 a month or $5,000. And now we're only being charged interest on the $5,000, not the 12. And we keep that balance for 27 days because we arrange that all of our expenses are going to be paid on the 28th. And so on the 28th, the $5,000 comes up in terms of mortgage or rent or utilities, credit card bills, whatever it is. Well, where do we get the money from? We get the money out of the line of credit. So we have 27 days at a $5,000 balance, and then it's going to pop back up to 10,000 for 3 days. And that blended average is what you're actually paying interest on.
So it seems to me like part of the system here is to try to consolidate all your payments so that you don't have a long gap there for the interest to add up.
100% correct.
Okay.
Because think about how the system is set up, how it is set up by default. For most people, the largest purchase they're ever going to make is a house. And we already established this is a one-way street in front of you. So what do you have to do? You have to park your money in all of these other places: checking accounts, savings accounts, CD, money market. There is a reason why money is called currency. It has to move. It has to flow, just like an electric current. That electric current's going, that this computer is working, that we can talk to each other. The lights are on, that I can see you. Okay. The economy works the same way. The money has to move. But when you park it in your checking account, who's moving the money? The bank is, for their own benefit. And so what we're doing is we're trying to take everything that's sprayed and prayed around and get it all into one funnel, one laser point, that every dollar is working for you within your own economy.
So then in your view here, in the bank, I may not have a savings account or a checking account. I just have the line of credit.
Correct. The
Okay.
checking account, depending upon the state, okay, and for most places this is going to work. The checking account is just a pass through, that the money has to stop there, and then once you see it's deposited, then you're going to move it into the line of credit. And then when the expenses come due, the couple days before, you take it out of the line of credit, move it back into the checking account so all the bills can get paid.
Okay.
So it's just passing through, okay? But it's creating this opportunity of just cash flow efficiency, because while the money is resting, while the money is just sitting there, it's sitting in the most efficient place for you and not for the bank.
Yeah, because who wants to feed the bank?
Well, let them feed on everyone else who's not
Yeah.
listening to this podcast.
I'm feed on you. So, okay. Is there anything you have to do on the other end, like making arrangements with the bank, or you just go in and you just do this?
Fantastic question. So I'm going to assume that most people who are listening to this are homeowners, just to keep this as easy as possible. So if you've lived in a home for, let's say, several years, especially if it's before 2020, chances are your home has appreciated pretty substantially compared to the debt that remains, and there's a lot of trapped equity. That's what we're trying to access. So let's just say that you bought the home 5 years ago for 300,000. Now you look on Zillow, it's worth 500,000, but you've paid down the mortgage sum. So now you're, let's call it 250,000. If it's a state like Texas, you can play with 80% of the equity. So if it's a $500,000 house, 80% means we can play or manipulate with $400,000. The first 250,000 is being taken by the mortgage. So we can get a home equity line of credit of $150,000 behind the mortgage. And this now lets us play the game. Okay. I've had some of my clients say, why do I need a line of credit so big? And my answer is because the bank will give it to you. No one ever has a harder time sleeping when they have access to more money, period. And because you just don't know what life is going to throw at you. For example, because of being a dentist, a number of my clients are dentists, okay? But I don't care. Dentistry is still a small business. It doesn't matter what it is. But I had one of my clients reach out last November and say, "Hey, guess what happened to me in September?" I'm like, "I don't know. COVID?" Like, I had no idea. They're like, "No, two brain aneurysms and a mini stroke."
Wow.
Lois, she's 46 years old. I don't think if she were to write out her ultimate life plan, I don't think having a stroke and living in the ICU for 3 weeks and having brain surgery was on that list. But it happened. As she wrote to me, thank God I had the business line of credit in place. I don't know what I would have done without it. The funny part about that story, the spouse or the husband thinks what I do is complete voodoo nonsense. And so they didn't do anything on the personal side. She only did it for her business. But if they did do it on the personal side, their cash flow would have gone up $40,000 for the year, and they would have had access to another $1 million. Would you sleep better at night knowing that your spouse is having brain surgery and you had access to an extra $1 million of cash just in case you needed it? This is what I'm trying to convey to people. It's great to be able to pay off debt. It's a lot better when you have access and you have flexibility because you just don't know what life is going to throw at you.
Yeah, in my mind, I'm thinking, well, I need to be cautious about this money. I mean, I'm not just going to go and do a European round the world vacation on it. I mean, this is like security money. It's not flingy money.
And I think I'm going to kind of rephrase this into a question. Where do things go wrong with this?
Oh, thank you. That's a great question.
Yeah, because it's one of those. I want people to live. If that around the world cruise is on your bucket list and you're just like, this is why I work so hard, then we build it into the plan and know that, okay, this is going to happen because this matters to you. And I'm not asking people to, short live things to be able to get to the debt free date. That's not the goal of this. The goal is to be able to have those experiences. But where does this go wrong? Number one, you have to have the cash flow. If your income is not greater than your expenses on a consistent basis, this will not work, period, end of story. Number two, the rate is variable. People get scared about the interest rates, but we already talked in terms of the car idea, the 0% payment versus the 10% interest. That's a small example for me to just tell you the interest rate does matter. It's the minor factor. It's the banks being magicians saying, look at the interest rate because this is the only thing we really want to talk to you about. But it's the balance of the debt remaining that matters more to determine how much interest you actually have to pay. Number three, a line of credit can get closed. And everyone was always going back to 2008, 2009. And I thought they were closing lines of credit on people everywhere. The answer is not really, because you only heard the headlines from Mace Bank and Hell's Cargo and Crank of America and Capital One because they're the mega banks. They're the ones that are going to get the headlines. But when I have spoken to enough of them now, regional banks, community banks, credit unions, as long as people were being good stewards of their line, they didn't have to do anything. And this is what I'm teaching is how to be a good steward of this. The final risk factor, which plays a little bit into your around the world cruise, is you raid the piggy bank. Okay. So I've got an acquaintance, and I use that term very loosely. At one point, the husband was part of the Watch of the Month Club. And I think they still have a car lease payment of $1,300 a month. And if I showed this couple the system, they would start it, They would raid the piggy bank. They'd come back to me and say, Howard, this doesn't work. And I'd say, no, you're just an idiot. You're an idiot that happens to make a lot of money, but you're still an idiot. And so you know you better than I know you. And if this idea, in terms of having access to a giant wad of cash, your next thought is, I'm going to go buy my next Lamborghini, or I'm going to go buy my first Lamborghini, then this might not be the right system for you.
But I hear they keep great value.
They may. I just I just want to know that you already have the cash flow that you can purchase the Lamborghini anyway. You don't need the access to the equity of your house to be able to do this and then hope to flip it later for a profit. That's not the goal of this.
Yeah, I'm just giving you a hard time. So I
You're not
really,
giving me a hard time. Yeah.
very interesting system. So how did you come up with this idea?
I can't say that I came up with it. What ended up happening is, well, the YouTube University, I saw some video way late at night a number of years back. I was like, I'm too tired. I'll look at this in the morning. That morning turned into all weekend, where this whole concept that actually started in Australia almost 25 years ago. Down there, went from Australia to the UK to the Canada to here. Down there and in the UK, they're called offset mortgages. And again, it's just the idea, instead of having a line of credit, it literally is your mortgage is open ended, so that you put all the money in, and when the expenses come due, you just take the money out. But it's all your checking, your savings, your house, your mortgage are all in just one spot. And once I understood how this worked and I saw the math behind it, I was like, this is the most logical way I've ever seen how to do this. Because I remember when I first bought my first house, I was just like looking at those first few payments. I'm like, this isn't moving. Like, when is this ever going to get paid off? And you just sit there and you rack your brain, and you just come up to all these obstacles. Like, what if I do this? What if I do that? And it's like, I still have this death trap for the next couple of decades. Like, this just sucks. And so once I saw how you can flip the script, because now it's an open-ended tool, I was like, oh, now this makes all the sense in the world.
Oh, great. All right. So what's the first meeting with you look like for somebody who wants to reach into you and get your services to help them set this up?
Fantastic question. Yeah, so we start with a clarity call. It is, I have to know where you're at. What are your numbers? Do you own a business also? Let's get the business numbers, because what I realized with dentists, starting with dentists, is that if I can improve the business and they're the business owner, where's that extra money going to spill over? It's going to spill over to their personal life. So it becomes this flywheel effect. So we get all of the numbers. I do the analysis. I come back with you and your partner slash spouse. They have to be on the second call, because you try and relay this, it's a disaster. It is not going to work. Period. End of story. I've tried it. No. Um, and then at that point, it becomes your call. It's one of those that you don't owe me a dime until we know we can get a line of credit in place. Because if we can't get the right tools, then I can't help you. It's just like, you go see someone building a house. If all they've got is the hammer, it's like they're not going to get very far. But so we've got to make sure that all the tools are on the table, see all the potential optionality of where we can get lines of credit from, so we can always just pull levers. And then it's being a guide, Lois. So my partner Nicole, she owns two Pilates studios. And so Lois, just pretend that we were in the same town. You were seeing Nicole for Pilates. And one day you just go in and it's like, Nicole, I'm just exhausted. Here's the rate for the hour. Can you do the workout and I get the six-pack abs? All right. People
Oh,
kind of
she
do
would
it
be
and they
very
love it.
wealthy.
She'd also be very tired. But yeah, but it's one of those that even though I know what bank you're using, I don't have your login. I don't have your password. I want you, I will be the guide in terms of when you move the money, where, and how much. I want you to be able to do this. So all of a sudden, it will take usually about 90 days or so, but all of a sudden, it will just click where you're like, oh, that's what we're doing? That makes so much sense. And it just has happened so often that people just have to, they borrow my belief until it finally clicks because they're seeing it with their own numbers and then the belief gets transferred. So, yeah, so everything is 100% complimentary until we get to the point of getting a line of credit. And if you want me as your guide, great. If you're like, nope, I think I can do this on my own, then I have done my blessing for the day and we move forward. So, yeah.
Great. You have an ebook. Tell us about the ebook. I'll have the link below for the ebook. Okay, Giant Builders.
Fantastic. So, yeah, so with the ebook, it goes into the 3 lessons or the 3 reasons on why this works. Even at the end, there is a quick and dirty sheet that someone can print off, scratch their numbers out, should take no more than 5 minutes, and you can email it to me and say, hey, I'm just curious, what would be the approximate ballpark in terms of being debt free? Because I have to lead people in a direction. So I lead them towards being debt free. Not that that's the be all end all. And if I come back and say, yeah, you're telling me you've got 28 years left on a house and 5 years left on a car, but we could pay all this with what you're sharing right now, we could pay all of this off in 4 years. If that sounds of interest to you, let's delve a little bit deeper. Then we get on the calendar and we move forward.
Wonderful. All right. Wow. Okay, this is you've opened my eyes to a whole new concept of money, and I really appreciate that. Any closing thoughts?
Just financiallyled.com/ebook is where you can go. And now, Lois, I am just honored to be on the podcast and that you gave me an opportunity to share what I've been able to learn and how it can just help people.
Well, I am honored that you came on to share with people this interesting and wonderful process that could help people get out of debt. That's really great.
Well, thank you.
So, all right. Well, thank you, Dr. Palansky. I appreciate your time. And Giant Builders, we'll see you next week.
Thank you for listening. This has been The Giant Builders with Lois Wyant.